Do not even think about going to your bank if you are trying to get money to start and grow a business. Look, it's the worst mistake you could ever make trying to get the money you need from a bank. Look, there's way easier and better sources that can get you money with less headache and way faster than you're ever going to find with a traditional bank. Don't get me wrong, traditional banks have their place. And in this training, I want to map out an entire blueprint for you to be able to fund your business. I'm going to tell you when you should go to traditional banks, but most of the cases, 95% of the time, you shouldn't. And I'm going to tell you where to go instead. This is going to help you avoid a lot of headaches because you're going to have a path to success with getting the funding you need without all the blockers, without all the barricades, without all of the denials. We got a lot to cover, so let's dive in. First of all, I got nothing against the big banks. They have their place, but their place for us as entrepreneurs is to lend us money when we are very well established. I mean, years down the road when we've got tax returns and we're profitable and we've got money in the bank, that is when we want to consider going to our bank. And here's why. First of all, banks focus on conservative risk. Most banks are FDIC insured. So the government requires they be conservative with their risk. And look, let's be honest, most businesses fail. So risking businesses or lending to businesses is very, very, very risky. So what we want to do is go to a place where they don't care about the risk of starting a business or newer stage businesses like big banks do. See, big banks don't even really lend to small businesses. What they do is they use SBA loans instead. And SBA guarantees that if they lend you money as an entrepreneur and you default on that loan, well, then SBA will cover like up to 90% of that defaulted amount. So this is what makes it practical for banks to lend to us to begin with. They're using SBA loans. But one of like SBA's basic requirements for most of their loans is 2 to 3 years worth of tax returns. And they want to see revenue. They want to see revenue increasing year after year, and they want to show profits on those tax returns. The problem is, as entrepreneurs, we're typically years into business before we have tax returns that show the growth, that show the revenue, that show the profits. This is why you don't even want to think about going to a big bank unless you have really good personal credit, financials that show profit, and some kind of collateral equal to the amount that you're going to borrow. Again, probably not going to happen until later in the stages of your business. So where else can you go? Well, there's many different paths that you can take to get capital. I call this the 3 C's cash access formula to make it super simple to be able to recognize where you can get funding in whatever stage of your business you are in right now. So the first C is credit. Do you have good personal credit? If you do, that opens up funding options for you. You can rely on that C and that C alone. You don't need cash flow. You don't need collateral. All you need is good personal credit, and you can use good personal credit to fund your business. There's a phenomenal program called Credit Line Hybrid where you can use personal credit for yourself or somebody else. It could even be a guarantor, a family member, a friend. Half of our clients that get this program have bad credit. They're using somebody else's credit to qualify. So it doesn't matter if your credit or somebody else's credit, if you're able to get up to $150,000 in financing, even as a startup with 0% rates. And it's no doc. It doesn't even require a bunch of documentation. So if consumer credit is your strength, that C, then you want to look at a program like Credit Line Hybrid. Now, the other part of the credit of the C, the 3 C's formula credit, is business credit. You need to start building business credit right away in your business. Here's why. First of all, business credit will pay for like 90% of whatever it is that you need to buy in your business. It can help buy equipment and furniture, and it can help buy computers and office supplies and all kinds of supplies and materials you need to actually do whatever it is that you do. 90% of what you need to buy to launch a business or grow a business credit can buy. And it's some money that anybody can get. Like your personal credit quality doesn't matter. Your collateral doesn't matter. Your cash flow, none of these factors that affect your ability to get other kind of loans matter. Everybody can get business credit, and it's a powerful way to be able to fund your business. So do you have good consumer credit? Does someone around you do? Well, then look at a program like Credit Line Hybrid and start building your business credit. That's going to get you access to a lot of money very quickly that you're able to use to launch or to be able to grow your business. That brings me to the second C. The second C is cash flow. Now, once your business is generating cash flow for 6 months or more, well, then there's all kinds of options where you can get funding just based on the consistency of your cash flow financing, revenue lending, merchant cash advances, term loans. All of these are examples of financing you can get just because you have consistent cash flow in your business. Personal credit quality doesn't matter. So a lot of these type of funding programs will approve you even if your credit score is 500 or lower. Some of them have no credit score requirements whatsoever, and they don't require collateral either. All you need is 6 months worth of consistent cash flow, preferably about 5,000 a month in revenue or higher, and it unlocks all of these types of funding for you based on cash flow. So now we've talked about 2 of the 3 C's. We talked about credit-based financing, right? We talked about using business credit to fund your business and using personal credit to fund your business. Then we talked about the second C, cash flow financing, merchant cash advances, term loans. All of this glorious financing is available just because we have consistent cash flow. And that brings me to the third C. This is the biggest category of business funding that exists. There's more types of financing for us as business owners in this category than the other 2 combined. And it's called collateral-based lending. Sometimes it's called asset-based lending. And the reason this category is so big is because there's so many freaking things that we can use as collateral to be able to get financing. Now, if we're just launching a business, we might want to look at stocks, bonds, 401ks, IRAs. Again, it doesn't even have to be yours. It can be stocks, bonds, 401ks, or IRAs of somebody else other than you. It can be cryptocurrency. You can get business loans using cryptocurrency as collateral. Now, there's a lot of other assets that can work as well. Commercial real estate, residential real estate, commercial or personal vehicles you can actually use. Once you're in business, maybe you need to buy inventory, you have inventory you can leverage to be able to get money. You can use equipment. So most assets you have on the personal side or the business side can be leveraged to get you collateral-based lending. And here's the best part. With this, you don't need cash flow. You don't need good credit. As a matter of fact, most asset or collateral-based lending doesn't even look at personal credit quality. So your personal credit can be horrible. You could just be launching a new business and you could have no cash flow and you could still get like 5% interest rate credit lines using one of these assets as collateral, even if they're not your asset. So now you have a lot of different ways to fund your business. You could fund it based on personal credit. You could build business credit. You could use consistent cash flow to get financing. You can use any different kind of your assets or somebody else's to get financing as well. That is the 3C formula. Now, there are some other things that are outliers of the 3C's formula. And some of these things are crowdfunding, for example, grants, for example, and another is actually venture capital or angel investing, what we call equity versus debt. So you're not taking on any kind of debt. You're actually getting money by giving up equity in your company for those kind of financing options. So those are outliers that don't necessarily fit in the 3C's formula, but there are other ways you can fund your business even if you have none of the C's. There it is. There's your blueprint. You use credit-based financing to launch the business, especially business credit. Then once you start generating cash flow, now we're getting cash flow financing, merchant cash advances, term loans to throw gasoline on the fire and grow even faster. Now we start to acquire assets, right? We start to acquire account receivables and inventory and equipment and all the things we have in business that make the business worth more money. Then we leverage those assets to get even more money. Now we have all 3. We have cash flow, we have credit, we have collateral, and now you can walk in your bank. Now you can have the requirements of an SBA lender. So now you can go get those SBA loans. So now you have a blueprint from startup all the way to major growth to be able to fund your business. If you got value from this training, make sure you like and subscribe. And don't forget to grab our guide on 27 killer ways to get the money you need to grow your business. This has a lot of secret ways that no entrepreneurs even know about. So make sure you grab that creditsuite.com/27. So like and subscribe, and I look forward to seeing you on our next training where we talk about more cool ways to get the money you need to start and grow your business.